Welcome back to our Talking Economics series, and joining me today, the Commonwealth Bank's Chief Economist, Shephen Halmarick. Stephen, thanks for joining us.
My pleasure, thank you.
Stephen, looking globally, what's your view on the US election result and its impact on the Australian economy in the future?
Well, it certainly was an emphatic victory for President Trump, returning to the White House now on 20th of January next year. Markets have been worried for some time now that President Trump's policies are inflationary. So we've seen inflation coming down in the US Federal Reserve being able to start lowering interest rates. But the concern now is that things like the tariffs, deportations, tax cuts may stoke some inflationary pressures again. And in response to that, we've actually raised the low point where we think the US Federal Reserve will be able to get interest rates down to. So previously we thought the US Fed could get interest rates down to 3.25% next year. We now think they'll be able to drop them to 3.75%, so an increase of 0.5% there. Recently, the US Fed continued to lower interest rates. They're now down at 4.75%, so there's a little bit of a way to go. But the reaction for Australia, or the implications for Australia, are part of this global concern about interest rates being a little bit higher because inflation's a little bit higher. Hopefully we'll avoid the worst of the tariffs. The US has a trade surplus with Australia, and Australia sells many things that the US is keen to get their hands on. So we think we should be in a relatively better position here in Australia compared to most other economies.
Going back to the start of November, the RBA again held the cash rate at 4.35%. Talk us through that.
Yes, that's right. So unchanged monetary policy again in November from the Reserve Bank. Cash rate's been 4.35% now for 12 months. And the Reserve Bank Governor continues to send the signal that she really wants to see inflation down into the target range, the 2 to 3% target range, on a sustainable basis before they start lowering interest rates. So we now think that will happen in early 2025. So we're expecting the first rate cut in February 2025. That's the first meeting for next year. And then 100 basis points or 1% reduction in the cash rate over the course of 2025. So by around about this time next year, we think the cash rate should be down at 3.35%.
The CommBank Household Spending Insights Index for October released. Can you talk us through those results?
Yeah, so October did see an increase in spending, up 0.8% on the month, but that followed a decline of 0.9% in September. So if we can see for the first few months of this financial year, spending has improved a little, but it's still, we think, weaker than what the government and the Reserve Bank would have expected. But in the month of October, the standouts were some increased spending on household goods, things like online marketplaces, discount department stores, hardwares, and actually quite a large increase in spending on recreation, including a 27% increase on the month in spending on ticketing services. So that's people buying tickets for big events, such as the Oasis concerts, Melbourne Formula One Grand Prix, Metallica, things like that. So people are still spending some money on those big recreation items. In contrast, we're reducing our spending on things like utilities due to the government rebates, and transport spending's been down in the year to October as well on lower petrol prices. So it's still quite mixed, but certainly a little bit of a better month in October.
And finally, Stephen, as we close out the calendar year, what are the key data points you'll be focused on?
Well, there's one more Reserve Bank board meeting before the end of the year, around the middle of December. And so ahead of then, we will get the September quarter national accounts, so GDP numbers. They come out in the first week of December. We think they're going to continue to show very modest economic growth, probably a little bit under 1% on an annual basis. That's the weakest growth in 30 years outside of the pandemic. We get employment numbers, wages growth numbers. They're likely to show some further softening of the labour market, but only very, very slowly. So the data over the remainder of this year, I think consistent with what we've been seeing for quite a number of months. Very modest economic growth, inflation continuing to decelerate, but the labour market kind of holding in a bit stronger than previously expected, which is good news.
Stephen, thanks for your time.
My pleasure. Thank you.